Hello and welcome to our monthly meeting of virtual seminar series on central banking and digital currencies. Today's host is the Federal Reserve Board, and I will now turn things over to our moderator today, Francesca Carapella.
Thank you, Jonathan. Welcome, everybody. Today, we have the pleasure of having Harald Uhlig present a paper and Michael Sockin discuss his paper. Harald is the Bruce Allen and Barbara Ritzenhaller Professor in Economics at the University of Chicago, where he's been since 2007. And he is also a fellow of the Econometric Society since 2003. And since he graduated from the University of Minnesota in 1990, he has done extensive work on applied dynamic stochastic general equilibrium theory on a variety of fields, including growth, dynamic contracts, business cycle, but also financial crisis and monetary economics. Michael Sockin is an assistant professor of finance at the McCombs School of Business at the University of Texas at Austin. And since he graduated from Princeton in 2015, he has significantly contributed to the literature on information aggregation, learning, and noise in financial markets, and more recently to the fast emerging literature on digital innovations. So we're very happy to have Harald present his paper on the crash of the Terra Luna stablecoin pair, and Michael discuss the paper. I will be moderating, keeping track of time and keeping track of the questions. So I welcome everybody to ask questions in the chat, and I will bring up those questions to the speakers. And Harald will have 25 minutes, after which Michael will have 10 minutes for the discussion, and then we will have a Q&A session for the remaining 20 minutes in the seminar. And Harald, you are welcome to start, put up the slides, and
okay, well, thank you so much for the kind introduction, and thank you for the invitation to speak here. So that's really good, and I'm hoping there will be some interesting feedback, and looking forward to the discussion by Michael, obviously. So let me get right into this. So this is about the title of the paper is a Luna-tic stablecoin crash, and it's about the, as Francesca said, about the Terra Luna system that crashed in May last year. So let me just briefly explain roughly what happened. I mean, it's now a year ago, but not quite a year ago actually. But these instabilities in stablecoins, seem to keep on coming back. I have to say something about that a little bit more. Now, what happened was that a group, I think in South Korea, essentially created this algorithmic stablecoin, Terra UST. And I'm going to explain in a moment how that worked, but it lost more than 75% of its value in May 2022. So it certainly, it depegged and then just, it just went downhill from there. And that led to price collapse of the underlying Luna token of 99.9%, and an increase in Luna supply by a factor of 19,000 in the ratio of more than $50 billion. So, that's quite a bit of money, and seems like, we're thinking through what happened there. So how did the system work? The system worked by allowing traders to convert a Terra UST coin into $1 worth of Luna tokens and vice versa. So these Luna tokens, they were freely floating. That was a freely floating cryptocurrency with a price, bumping up and down. Let's say suppose it was worth $100, right? Then you could take 100 Terra UST tokens and get one Luna token for it, and then maybe sell the Luna token on exchange like Binance or some other exchange. And if the Luna token was only worth $50, well, then you would then 1 Terra, 50 Terra would buy you 1 Luna token, and vice versa. So the system was set up to do this. Of course, you could also buy Terra directly on the exchanges, and you could buy and trade Luna directly on the exchanges. But the key, and I would argue clever idea here, was this blockchain-based, system-based exchange of one with the other So when you wanted to burn Luna into Terra, the system would somehow look up the current price for Luna and give you the appropriate amount of Terra tokens and vice versa. Eventually, sustained outflow on or burning of the USD tokens, of Terra tokens into Luna results in a collapse of the system. Many have argued that this affected the cryptocurrency market as a whole. There's an estimate by Barron's that say that that market cap of the crypto market declined by $600 billion, or that $600 billion were wiped out, and that obviously is that's a substantial number. So that's a key figure that was cited in the White House proposal on crypto regulation, and then the Luna crash, the recent FTX crash, and other things are also important drivers of the MiCA regulations in Europe, which are actually pretty far advanced in introducing tailor-made regulation to the crypto asset market. Okay, now, oops, here. So here's a picture. I had longer slides that show this a little bit like a movie, but here's a picture of what happened. So the USD price is in black, and it actually held fairly stable for nearly a year. So it was spot on $1. The system worked, right, and all was nicely. And here's the Luna price, and now you're seeing down here the blue is the burning. So that's how many people take the Terra token, the token that's pegged to the dollar, and turn it into Luna. And you see this picking up here, but it's not entirely clear if you look at this picture, what was cause and effect. Was it that this was picking up and therefore this started to peg, or this started to decline, and what was going on? And in any case, the bulk of the burning took place much later. It took in terms of the way these financial markets work, right? I mean, it took 24 hours for the burning to really go full scale, and eventually the price of the underlying Luna token, because Luna tokens were now getting increasingly diluted by all the Terra that was converted to Luna, dropped so far that that the blockchain was halted and the convertibility was halted. Now, there are a couple of interesting things here that I want to understand. One is, what's the evolution of the price? How can we understand the evolution of the price of Luna? Why did it take time? There's also something interesting that one can say about the evolution of the price of the UST, but I probably won't get to that today, because there's a lot going on here in this paper, and I can only talk about a subset of it. Okay, so I want to understand these events qualitatively and quantitatively. So I'm going to build a theory for the underlying Luna token that gives me a gradual unfolding of the Luna crash, given a certain rate of the Terra burning. That is, assume that there are people that just want to convert their UST dollars into Luna for some reason, and that rate, what should be happening to the price of Luna. And I can get get some differential equations. I can get some closed form solutions, so that's very nice, and I can compare them qualitatively to the data, and will argue that already looks pretty good. And I can do the same thing for Terra UST. Again, I'm not going to talk about that much today. I mean, it's in the paper if you want to look. But the theory then also allows me to interpret the data. So the theory contains key pieces that investors essentially think about, and I can try to back out these pieces from the theory variables to deduce what it was that investors must have in mind, in light of the theory. And then I don't just get qualitative goes to the data, I can pretty much exactly replicate the data doing that. And I call that the method of quantitative interpretation. It's a version of sort of related to identification, estimation, calibration, if you like, but I think in some ways it's different. I'm not saying that other people haven't used something like that, but I feel it deserves a new name. So that's what I'm proposing. All right, now doing this runs into a challenge, and that's how you want to price cryptocurrencies. The net present value of these things is zero, so they're no different from other fiat currencies. And there's literature that looks at competing fiat currencies and how to price that. There's a famous paper by Carrick and Wallace that has pointed out that if people treat these currencies as equivalent, there's then exchange rate indeterminacy. And the version that I want to advertise from my paper with Linda Schilling, that's downloadable for free from the Journal of Monetary Economics, published in 2019, where we think that through, and we argue that the price for cryptocurrency should be risk-adjusted martingale. So MT plus 1 here is a risk factor, if you like. The expectation of that thing is 1. If you don't like that, just think that QT is the expected future price of the cryptocurrency. So it doesn't appreciate with an interest rate. It doesn't depreciate with an interest rate. You know, if you ask me, you know, what's my best prediction for, you know, the Bitcoin price 10 years from now, I look at the Bitcoin price today, and that will be my prediction. I mean, that's essentially what's going on. And these here, you know, we are just replicating essentially results that were already incurred in Wallace and manually pick. All right, so maybe then the system should have worked, right? If the price is a martingale and there's people burning the Terra into Luna, and the surprise movements in the Luna price are uncorrelated with this, you know, why should they be correlated with these inflows? Then, you know, the burning of the Terra UST could have just been absorbed by a higher market cap of Luna rather than a price collapse. But clearly that's not what we saw. So you need something else. So you need a new assumption. And the assumption that I'm going to make is I'm going to impose something on the evolution of the market capitalization. In particular, I'm going to impose that, you know, once the system crashes, you know, there's going to be certain market cap. There's only a limit of how much people want to hold that stuff in terms of, you know, valuation, and how much it would be valued if the system, you know, somehow survives. There's clearly tension here to these martingale results that are in the previous slide, and it's just good to keep that in mind. The second thing is, how come that the crash unfolded gradually? If you just write down a simple model of the rational expectation, the crash should be immediate. You know the burning is coming. You should immediately say, okay, how much is therefore Luna worse, and that should be that. After that, the price should be constant, and clearly that's also not what we saw. And I solved that by continual hope for resurrection. So the model will have this martingale property, despite from the fact that the price visibly, you know, gradually declined. It certainly looked like a, you know, gradual decline, you know, obviously, rather than anything that looks like the expectation of future price were the same as the current price. Okay, so let me start with the pieces. Here's a very, very simple version of the theory that doesn't contain the dynamics yet, but it helps to clarify a few things. So imagine there are 2 periods, one before burning and after burning. There's an initial Luna stock, so there's a number of tokens M, and there's a price Q, or an exchange rate, if you like, to the US dollars. The rational traders, you know, they would only trade this if there's the same price in both periods, otherwise opportunities for arbitrage. And let's say there's a burning B of UST Terra tokens. So B is now measured in US dollars, where M is just units of Luna. Okay, then simple math tells you what the final Luna stock should be. You just take the current stock and you calculate how many, you know, at the current price, how many new Luna tokens are added, and that's just going to be B divided by Q, and that gives you the new stock. And you can rewrite this equation by multiplying through its Q. Okay, that's it. Right, and so now we need an assumption somehow to get us, you know, Q, right? And that's what we want. Okay, so I'm going to assume something about the final market cap. I'm going to assume that's on the left-hand side here. Now that's the capacity of the market in terms of value of absorbing that stuff. And let's just fix that. Once you fix that, you can solve for the underlying price, you know, just from that equation, you know, given the initial amount of tokens, capital M, and that's what you know, and that's going to be your price. Now, there are a couple of interesting remarks here, because I think there was some confusion in the discussion. What you need here in order for getting a positive price is that the eventual market cap has to be higher than the amount of Terra that gets burned, right? I mean, here now the little m is now expressed in US dollars and the little b is expressed in US dollars. And so the difference better be positive for the Q to be positive. But it could well be that the current market cap before the burning starts is smaller than B. So sometimes people have, you know, compared the current market cap to the amount of outstanding Terra tokens, and that's just not the right way of thinking about it. Now, next, we need to introduce the dynamics and how to get the gradual crash. And let me motivate this a little bit, right? So this is another picture here of this decline of Terra. I mean, the theory is about Luna, but I think that looking at the peg itself is kind of interesting, right? You saw this price collapse of the Terra token here, and but did it have to collapse? Well, I'm going to point to another recent collapse that was for the USDC. You remember the Silicon Valley Bank, you know, went into trouble. You know, part of the deposits, they actually backed up the USDC token. And so the USDC, you know, depegged, right? And there could have been, you know, like on this picture, an eventual total crash of the USD system, but somehow it recovered, and the the people running USDC took measures to to assure the markets, and it restored. So the argument that I'm going to make is that why this crash is happening, you don't know whether you're going to restore the system as it's here, or whether it's going to be fully crashing as it's there. All right. So let me write this down explicitly. I first do it in discrete time, then I get a continuous time system, and then get differential equations. So at time t equals 0, everybody suddenly realized, oh my God, burning begins, the system is under stress. And I'm going to treat BT as exogenous for this part. The second part that I can't talk about due to time, I would talk about how to think about this BT here. So then at t, and within this short next time interval delta, there's going to be burning of BT delta USD tokens into the corresponding amount of Luna tokens. So I have to divide by the current price Q to figure out how many Luna tokens I get. And I get sort of a version of the equation that I just on the previous slide. Now I'm going to make this assumption too, continual hope for resurrection. So with some probability lambda t times delta, this whole thing stops, right? The burning takes place, all right. But then after that, the nightmare's over and everything returns to normal. And we exit this whole situation with a market cap nt plus delta. But then with probably 1 minus lambda t delta, the burning of the USD continues, and we keep on going until the Luna price reaches some very low value. And then we suspend convertibility and we exit with some exogenous given market cap. So I want this MT possibly be different from this NT here, and we'll see how that plays a role. The rational traders price the Luna tokens. I take this dilution into account. I can write down the equations. If I let delta go to 0, I get a system of ordinary differential equations. There's lots of things I would love to talk about here, but let me not bother you with all the differential equation math that goes on here. Let me just show you instead some pictures. So here's something, okay. But here's the, here's how you can envision this burning, right? You stand at T, here's the total amount of outstanding tokens. Here's the market price for these things. There's some burning that takes place. These are the additional new tokens, BT, that's a burning rate, right? So then during this time interval delta, it's BT times delta that gets burned, divide by the market price, these are the additional tokens, and that gets MT plus delta. MT plus delta will just be MT plus these new tokens here. And then, either you're going to be exiting with market cap to NT plus delta, in which case these tokens here will be worth NT plus delta, and then you can figure out the price, or the burning continues, and then you get the new endogenous price from this here. All right, so differential equations, let me skip that here. Let me just show you some simulations. I imagine the initial market cap is 30 for 30 billion. That's the reason why I chose 30 there. The initial price, I just fixed that at 100, which was, somewhat less than that, but 100 is just a good number to remember. I fixed the exit market cap as the same 30, so that when the nightmare is over, sometimes early, you just return back to the same market cap as before. Everybody's happy. Let's just assume that, and assume that there's an exit rate of, or hazard rate of 0.05 per unit of time that the nightmare ends. But there's continuous burning, so I'm going to fix this burning here, in terms of this alpha parameter, which is given by B over lambda times N. That's one way of parameterizing that. And at 0, so at time 0, you realize the burning is starting place, but I assume it's only going to start a little down the road. It may not start directly at 0. So that's the assumption here. And then for T bigger equals T star, you get the burning, and then the stopping price is epsilon. So you can go through these scenarios here. If the burning starts right away, then the price should collapse right away, essentially. And if the market cap at the end is the same as exit market cap in normal times, you would actually get a market cap that goes down and goes up again. That's not what we saw, what happened. So instead, I'm gonna postpone the actual burning to hour 50. So there was so the big burning starts later, as we have seen in the original data, but the price is already collapsing in anticipation of this burning that's going to take place. The market cap collapses, but then recovers, because here I'm still assuming that the capital MT is equal to the same N as before. So I have to make this exit market cap in case this system collapse small. And that's what I do in this next picture. So then eventually this market cap is going to be down here. And now you get a price dynamics that kind of looks like the data. So the next picture here is the data, and if I flip back and forth, you saw this late burning here. That kind of is, captures this late burning starting at 0. The late burning starts at 50. It's sort of stylized, of course. The market cap also has this double S shaped, I would argue. The price dynamics kind of looks like this, more or less, right? And so I think that's already a success. But I can go beyond that. I can use the data to actually back out what people must have thought in terms of the NT, the lambda-T, and the MT, and do all that. And there's a bunch of equations that I need to solve. The equations, but let me not worry about it. In a nutshell, you can only back out either NT or lambda-T. You can't separately back out the two of them. I mean, you get two equations, but nonetheless, you only get a combination of these two parameters. So you have to either make an assumption about NT, back out lambda-T, or make an assumption about lambda-T and back out NT. And that's what I do in 2 scenarios. And now I can actually replicate the price dynamics pretty much exactly. There's some 0 constraint that has to be obeyed. If you look at the lambda-T, that's what it looks like. So, you could argue that initially people were still quite hopeful. I mean, despite the bumps here, that the system will restore itself, but over time, this optimism faded, right? And this thing went into a tailspin ever faster, right? And so the beginning, people thought, okay, something is happening. Maybe there was an intervention here that restored people's confidence, but eventually it was gone. I think that's a probably reasonable scenario here. Fix the exit market cap. Here, instead, I fixed the exit probability, and then this exit market cap is becoming very erratic. It was kind of high in the beginning and kind of low in the end, being the counterpart to what you're seeing here. Now, what's interesting about this calculation is that you can back out the probability that you will not suspend, and it will eventually collapse, right? So initially, you're thinking, okay, this has to come to an end before we reach the epsilon price, but eventually, that optimism fades, and that probably goes to 0. And this here essentially provides a price floor for the UST token. So that's why that's interesting. And you can compare that. That's from the theory, from the simulations I did before, from the last scenario. And you can compare that to what happened now in the data as I reconstruct these probabilities under my 2 scenarios, A and B, depending on whether I fix the lambda and the T. And I can think of that as a price floor for the UST token, right? And so in this one scenario, I get this orange line here as my price floor for the UST token, and the other one I get the red line as a price floor, and you can see that's the actual UST price. I mean, it goes below the orange, so it's not a tight theory, but it doesn't go below the red. So I would say that's success. And from there, you can also think about what would it have taken for UST traders to actually get rid of their tokens. When would they be nervous enough to say, that's it, I'm going to burn my UST token, I'm going to get rid of it, I no longer want it. And what you find out is you can infer that, so that in the paper that's constructed in more careful detail, you can figure out the population distribution of the people being nervous enough of saying, now I'm going to burn my USD token. Remember, 60% of the USD tokens were still in circulation even after the system crashed. So that's just about the 40% of the USD holders that were still holding on. And what this says, for example, that even when the probability of a crash was 50%, so that would be here to the right is even higher crash, even if that crash in scenario A, only 20% of the USD holders were ready to say, okay, let me get rid of the token, even though there was a 50% chance of a crash. And even if you take the more benign scenario B, it's only about half of the people that were ready to cash in. So that's what you can then back out with the theory. Let me conclude. We saw the Terra Luna crash. I think it's interesting to study because we seem to be seeing, stablecoin crashes more often. And so just understanding one at a time, I think it's a good idea. There are the challenges of addressing the character and wallet exchange indeterminacy and the challenge of figuring out where it's gradual rather than immediate. So I solved this by imposing market capitalization and impose that this hope for resurrection, right? So that gets resolving 1 and 2. I get these ODEs, I can solve them, I get a stylized version of the data, but I can even go beyond that. I can do a quantitative interpretation of the data. I can look at the quantitative movements in burning and the prices to back out the theory variables that the traders must have had in mind. And it shows that the threshold probability of collapse in burning UST was above 50%. It was for more than 80% of the UST holders, right? So for half of those that actually burned, and there was still 60% left, and it was all said and done. Thank you very much.
Thank you very much, Harald. This is fascinating. Michael, the floor is yours. Harald has been, as a true German, right on time. And I can say that because as an Italian, we are known to be always late. So I really appreciate it. The floor is yours, Michael.
We can't hear you, Michael.
And yeah, you're muted.
Is that better?
This is great. Now we can hear you.
Okay, perfect. Yes, and let me just share my screen again. There we go. Wonderful. Well, thank you so much for inviting me to discuss this interesting paper and for the kind introduction. So what is the motivation? Stable coins are often pegged cryptocurrencies, typically to the US dollar or the euro, for instance. It could even be something in principle like the price of gold. They act as a store of value and a financial bridge across DeFi platforms and applications, such as for DeFi lending, often the argument being that they're much less volatile than a lot of prominent cryptocurrencies like Ethereum. So for investors and for traders, it's often something they would want to hold, for instance, for liquidity. So recent collapse of Terra Luna, however, has raised questions about their stability, and there's a nice review paper by Briola et al. In Finance Research Layers that kind of goes through the anatomy of this collapse. And unlike reserve-backed stablecoins, for instance, Tether or USDC, Terra Luna is more of a novel algorithmic stablecoin arrangement. And I'll caveat that a bit because the Luna Foundation did have roughly 3 billion in Bitcoin that it would use to defend the peg if ever needed. But in principle, the stablecoin should be somewhat self-sustaining because of the algorithmic, the arbitrage algorithmic mechanism in the background. So Terra stablecoins are anchored by their native token Luna. This is often the case, and I'll show you an example of another stablecoin that's anchored by a token. And can always burn 1 Terra for $1 of Luna tokens at the prevailing price and vice versa. And that's supposed to be stabilizing because the idea is there's arguably a riskless arbitrage if US Terra is knocked a little bit off of its peg. And that can be resilient for small shocks because for a little bit, less than 1% or 1% of 1% deviation, you can make a riskless profit and get out of Luna pretty quickly, or Terra if you're doing the trade. But it can be very destabilizing for large shocks because, once I've traded a large amount of Terra for Luna to be able to maintain the peg, that price of Luna or Terra may fluctuate in the next minute or so before I can unload my position, and that can be destabilizing. If I anticipate that the price of Luna is going to collapse by 50% 5 minutes after I try to defend the peg, that creates a limits to arbitrage type of argument that makes it difficult for me to want to defend the peg. So what does this paper do? It builds a novel framework for understanding the Terra Luna crash. It has minimal structure, which I really like. It's very transparent about what ingredients are needed. You have a law of motion for Luna price from the burning rate BT. It's very forward-looking, so everyone's internalizing what's going on and how Terra is going to be burned in the future. So everyone's fully anticipating this, but we still get a slowly unfolding crash. And implicitly, there is that hope for resurrection that Harald discussed, which is there's a market implied probability lambda t of recovery. Upon recovery, there's an exit market cap for Luna, and that's the hope that for traders who are willing to hold on to these tokens, that there's some chance that the burning will stop and the peg will be restored. So you can incorporate heterogeneity in UST holder beliefs to construct demand curve for UST tokens based on a threshold perceived probability of recovery. And Harald briefly discussed that when he was talking about that distribution of UST holdings that would lead to burning. And he provides an organizing quantitative interpretation methodology for bringing the theory to data. And there are many sorts of refinements he does to try to illustrate that his methodology can be flexible to incorporate some of the nuances of reality, such as the 2-hour observational interval for which he has the data. You can also use various different ways of measuring the Luna price. And what's kind of nice is he's able to infer beliefs lambda t fixing an exit market cap and vice versa. Those are the plots that he showed. And my one suggestion from a methodological perspective before I talk more conceptually is I'd like to see the quantitative interpretation to do a bit more. I want to get more out of this methodology. And what's nice is because you can do the counterfactuals and you can run a variety of counterfactuals, you can perhaps provide bounds for lambda t and MT. And you can use model-based inference, which is nice because with data alone, I can follow the price of Terra or Luna. And I can say, well, if I think the price is to first order approximating these recovery probabilities, I can roughly recover something from the data myself. What's nice about this theory is you can do counterfactuals to try to say, well, the inputs that go into the price are a bit more complicated, let me try to see what seems like a plausible range of probabilities so we can kind of put bounds on these things, which is also very important for not only the Luna Foundation trying to figure out whether or not it can defend the peg, as well as for arbitrageurs trying to defend the peg, but also for policymakers in assessing as this thing is slowly unfolding, what must be going on from a robust perspective in the minds of all the actors involved. So as I said, I talk about one other stablecoin. So there's Iron Finance, a 2-token system backed by the Titan token. It failed in June 2021, and somewhat similar to as Harald showed for the Terra token, you can see that it gets knocked a little bit off of its peg, and then it slowly seems to decline, falling first a little bit and then eventually collapsing. So one thing to take away from this is that the experience with Terra Luna is not unique for algorithmic stablecoins. And in fact, Harald's theory can perhaps be used to understand and rationalize this experience as well. And also perhaps from a bit more of a negative perspective, this means that this sort of risk that we saw with Terra Luna might just be endemic to this algorithmic stablecoin arrangement. So it's something to keep in mind going forward, that Harald's theory might be useful not only as an autopsy of what happened, but as a prescription for what may happen as we move forward in the stablecoin universe. So what I like about this is a new theory of slowly unfolding crashes. In the paper, it's often compared to a bank run. You have Diamond Dybvig, Zhang, but there are also several other theories of delayed crashes, and I'd like to see the paper speak a bit more to these other mechanisms. Like as I mentioned, there's the limits to arbitrage literature, so you have coordination failure, and some of my favorite papers come from this literature. For instance, Brew and Brunemeyer. So in Brew and Brunemeyer, there's a lack of common knowledge among arbitrageurs, that there's common knowledge that the price has moved away from fundamentals, and this leads to an endogenous delay before you see it collapse. And that's actually the key result of the paper, is that everyone knows that the thing is overvalued by time t, but it takes t plus epsilon before the crash occurs. And that's what they would call the strategic delay. You have heterogeneous beliefs with short sale constraints and lockup constraints. So if we go to the dot-com bubble, Hong Shakeman Zhang would argue that the release of lockup constraints for insiders slowly increased the asset float for various stocks, tech stocks during the dot-com bubble. And this caused the need to absorb the supply move down the marginal optimist in the market until eventually this couldn't be sustained and you have a collapse of the dot-com bubble. And also, just to cite some of my own papers, just because they're the most prominent in my mind about this channel, there's a lack of common knowledge also of fundamentals. So in this situation, we get price signals that confuse us about the right action. Think of the housing bubble in the 2000s. We get some early signals from New York and San Francisco, leads us to think that housing is strong. We build up, and after we build up, the price signals become stronger, and then we learned we overbuilt, and you have this sort of gradual collapse. It doesn't occur immediately because we didn't know at the time that things were overvalued. We slowly learned. So a comment I have for the paper is, what is slowly unfolding in the context of the model? It would just be nice to know, what is the benchmark? Is the t star equals 50 instead of 0 a notion of slowly unfolding? Can we endogenize that? It would just be nice to have a clearer sense of the benchmark, because I really like this idea. And then just from a practical perspective, Terra Luna crashed over several days, and is that slow compared to the dot-com crash in March 2000, which took several weeks, and if you look at the price for it, took about a few months. And there's also suspicions of strategic attacks on Terra Luna. So the Luna Foundation depleted about 80,000 Bitcoin in reserves, about $3 billion to defend the peg. And there's some evidence from that Briola paper that there were traders that were shorting Bitcoin ahead of time in anticipation of Luna having to liquidate its Bitcoin. Can we use the model at all to evaluate these alternative theories? So the next major point I just want to make, and I'll have one more after this, is arguably the Terra Luna crash is a crash of an intrinsically worthless asset. And it highly relies on self-confirming beliefs. Do we believe that we'll be able to support the peg? Do we believe in the future that Terra and Luna will have their value? So the algorithmic arbitrage mechanism for stablecoins to me is a bit similar to ETFs, as authorized participants would go and make sure the value of the ETF matches the NAV of the underlying. But there's no underlying fundamentals for the other one side of that trade. And the lack of fundamentals makes it vulnerable to being careened off the peg. And Luna did first try to defend this peg. So it'd be nice to know, how did Foundation's failed interventions impact market beliefs? And we can use Harald's model to try to understand that. We can actually see the moments in which Luna intervened, the Luna Foundation intervened, and see what it did for market implied beliefs. so we can understand if was defending the peg a credible action by the foundation. What's also getting a bit back to that discussion of coordination failure, the paper implicitly collapses strategic uncertainty into a first-order belief PT about the going forward probability of resurrection. And it would be nice to try to connect that probability through the burning rate back to lambda t to maybe endogenize it, as well as just to discuss the role of higher order beliefs. Do I believe that other people believe in this probability as well? And how does that affect my actions? Finally, just to conclude, it has some implications for policy. Algorithmic has different economics from reserve-backed stablecoins. Reserve-backed are kind of like high-risk money market funds, and algorithmic fuses economic incentives with technological constraints, backed by deep-pocketed arbitrageurs and devotees, constrained by protocols and burn rates, as we had a bit of a discussion before the webinar, that there's a lot of technological constraints involved in designing these things. And financial stability oversight just has to adapt to the new risks of DeFi, smart contracts, automated market makers, and flash loans. And it introduces some new issues, such as misdirecting oracles. As we said, Terra Luna has to look up the price of Luna and Terra before the blockchain, the protocol can make the conversion. You can also have algorithmic liquidity crashes, cascades that kind of amplify any sort of destabilizing activities in stablecoins. So thanks so much for giving me the opportunity to discuss this really interesting paper. And with that, I will conclude. Thanks so much.
Thank you very much, Michael. This was a brilliant discussion. Harald, would you like to respond, take a moment to respond to Michael before we go to the broader Q&A?
Yeah, sure. I'd be happy to. I mean, thanks. I mean, it was really an amazing discussion, and just realized I didn't take enough notes here to remember all the fine points that you raised, Michael. I think it really was excellent. You know, a few things. You know, the gradual thing here is about the gradualism in the price, and that's what I want to highlight. I mean, it's true that the burning itself was gradual, and that was probably gradual because the people that held USD tokens maybe came late to the game, or maybe the USD tokens were tied up in contracts and so forth, right? So there's probably a reason why the people that held USD tokens couldn't burn them right away, even as they saw the system collapsing. But the intriguing question is when the Luna then was priced right. We can look to Binance and look at what price was priced. Why was it priced at that price rather than some other price? At that point, you know, the people that were aware of the situation, I would imagine, and that's the harder one to understand. Why would that gradual? So the theory gives us a martingale result, and whether people only became overall aware of this crash happening later or earlier, that's still a surprise event, but would have to trickle out the news of this collapse happening piece by piece, and that's just super hard. I mean, essentially, in some ways, my probabilities of resurrection, if you like, a sort of a version of this. I actually tried to work once with a system where you try to forecast the forecast of others, and it became totally unmanageable very quickly. And so that's why the structure was chosen the way it is. But it's this gradual unfolding. So the price, again, the price on the market should be, in expectation of what happens in the future. The people are buying and selling at that price. Why that price? And that's a tricky part. Now, the other thing that you mentioned is the beliefs itself, right? Because the Luna, the fundamental value of that stuff is zero, right? And so of course there's a possibility that it drops to zero right away, and then game over, right? At that point, you can't burn any UST tokens anymore, right? And that's essentially also that's when my assumption about an exit market cap rescues me, right? Because it says from the construction of the theory it can never go entirely to zero. And I assume it to be deterministic, a richer version, you could make that stochastic in some version. And so it could be zero under certain circumstances. I would imagine that would be possible. But yeah, I mean, you're backing something that's with something that's intrinsically worthless. And the only way that can work is people are willing to assign a value to it anyways, because there's some transaction values. What gave it value is a very, very good question. I thought hard about whether I could somehow incorporate the intervention by the Terra Luna system. It's true they had about $3 billion Bitcoin worth of reserves that at some point were gone. It's not entirely clear where they're gone. the appendix of my paper goes to all kinds of blogs that have been posted on this and people speculating on this and was this speculative attack. I mean, it's super tricky. I mean, it's just another side is taking the market and you could think of that as an increase in market cap. Suddenly there are more people willing to hold that stuff, and maybe that's a lens through which one could see that. And given that the NT in one of these simulations, once you back it out from data, seemed to increase higher, so maybe that's a reflection of that. But it was unclear when the intervention happened, and I think there's where it happened, what happened with the money, so in the end I decided to just leave this all out. Yeah, so there's so much more to say about many of the things you raised and the points you raised, and interesting discussion. But I think it was fairly slow given this time and age when trades happen quickly and when there are all these smart contracts out there. And we're seeing this now, right? This is no longer 2000. We are now in 2022 in that case, and now 2023. People can withdraw money from SVB at the push of a button, and pricing happens practically instantaneously. And we have to be recognizant of that. And I think when you call out for regulation, taking that into account, I think that's exactly right. So thank you again. I mean, there are many more things, I have to think about them much more, and it will help me ultimately to improve the paper. Really appreciate it.
Great, thank you, Harald. Then I will move to the Q&A, and please, everybody, feel free to type questions. I will go with the first one by Chris Cameron, and he's asking, so this is so timely, your presentation is so timely, given the arrest yesterday of Dow Ones. And he's observing that given the poor structural design, what could Terra have done to minimize aggregate losses to Luna and UST holders once things became unstable?
Yeah, I mean, it's an excellent question, and Michael essentially hinted at the system maybe being stable if there was small burning, but not stable if there was large burning. And when has to unpack this a little bit more, the way the system worked, and I think that was maybe ultimately the Achilles heel in my mind, was that the system looked up the current price and then gave you the appropriate number of Luna tokens. But then it takes time to get that transaction on the blockchain, and then you had to get it from your wallet into, let's say, Binance. That takes time, and then you have to sell it there. That takes time too. And so I think what happened was that people were afraid that the arbitrage, when you see the price of Luna collapsing, that by the time you get your system out, you're actually getting less than what the UST was worth to begin with. I think there was even a bandwidth that was imposed that later on they tried to lift, that maybe have accelerated the whole thing. But if there's bandwidth, that probably creates additional panic of people getting through the exit door and then trying to sell it even at a lower price on Binance. And so I think if the system had been more anticipatory where the price would head, once you sell your token on the blockchain, the system might have been more stable. That would be sort of a very technical answer, right? But again, we didn't have an idea where the price should head. Now with this theory, you can now figure out. You can say, okay, if that's how the market capitalization evolves, and then if you see a certain burn rate, you know what the market capitalization will have to be next, and so you could give a few more Terra tokens, essentially, a few more Luna tokens if there's a lot of burning, right? And then maybe then people are happy and they would just hold on to the token. So you have to sort of think about the incentives for holding have to be higher, right? If people start selling that stuff and burning that stuff once it's just a bit under $1, then such a system apparently can unravel very quickly. I mean, that's sort of part of the answer and something that I think one can think through in terms of the theory here.
Thank you, Harald. Jonathan has his hand raised. Yep. Would you like to ask a question?
Yeah, thank you, Harald. I think it's very nice to have a tractable model that helps us, develop a quantitative interpretation of the phenomenon and the underlying forces. I have a question that may be related to Michael's comment, which is so since the underlying beliefs are unobservable, So maybe it would be nice if you can talk about how we can apply this method to test the validity of this particular theory, and maybe also against alternative, competing theories, right? Such as those, suggested by Michael that may involve, strategic action of large institutional investors or Luna Foundation gas intervention, things like that. How can we apply this method to, in general, differentiate validities of different competing stories?
Yeah, no, thanks, Jonathan. We would have to have a generally competing story in the first place. So I think in order to get, I mean, that would be nice if there was another theory out there that could get us this gradual evolution of the, gradually within a few days. I mean, you could say that's not particularly gradual, but still this gradual decline of the Luna price and this entire system. So I think the theories that Michael alluded to, they probably don't give you the full dynamics yet. And plus, they're about assets that have a fundamental value. So where's that coming from? So, I mean, there are things that would need to be done first in order to have an alternative theory, and then potentially one could test it. But you're absolutely right. At this point, there are two variables in the theory that drive, what participants are thinking. And originally I thought, well, I have two equations, so at least I can back out these two variables, right? If I had actually I have three equations and I have two variables. So then if I have three equations, two variables, I can even write down a test, right? I need additional equations. I need additional restrictions on these variables to allow me to test, to make statements on these things. But I don't, right? And it turns out in the end, I really just have one equation for two variables. So there's already a degree of freedom in the theory. And I can either fix the exit probability, or I can fix the market cap upon exit. One small test, and that was on one of these slides, is that the probability that you back out that the system will live provides a floor for risk neutral traders for the USD Terra token. And that's I mean, maybe I could show that picture again, but that's sort of, if you like, a small test for the theory, and it kind of passes that, but it's a very loose test, since you only know that the Terra token would have to be between that probability and the in one. So it's not a very stringent test. So it's really, it's how should I say that? I mean, you're backing out the values of the variables in the system that you can't observe from the observations, and then it explains the data perfectly. And you would need some other implications of these variables, or some other constraints on these variables, in order to say, well, I don't like these variables. Allow me to just super briefly, I mean, because I think it's such an interesting and important question, allow me just super briefly to share the slides here again to talk about this. Let's see here. Okay, here we are again. So, and I think Michael in essence was hinting at that too. So when I construct these variables from the data and do this quantitative interpretation, this is what I see, right? I get this for the exit probability. Well, there's already a restriction here. If so one scenario, I fix the exit market cap. So if the system survives, you just get back to the old market cap. That's what I'm imposing here as a scenario. And by the way, the paper in the appendix contains 5 other scenarios, because there's, and what exactly you fix is a little bit, up to the user here, since there are 2 variables that need to be inferred from the data, and I literally only have one equation once I think that through. So here back out this exit probability, and you can, it's a rate. So it's a rate, so that it could exceed 1. So that's not a problem, because it's a rate per unit of time. And so so I should probably call this an exit rate rather than probability, but it shouldn't be negative, right? It shouldn't be negative. And in fact, if you do some calculations, then you see the price go up, then the calculation want that to be due to negative probability, much more likely due to the intervention by the Terra Luna system, right? Where they just, started buying these things. But technically in this model, I have to impose that this is smaller or equal than 0. So then this restriction, what's one test of this restriction? Are you getting actually close to this price because you don't allow this to be negative? And that's the answer here. That's why there's a slight discrepancy between the actual price series and the constructed price series. You see this here, right? I mean, you see this here, right? Where the price goes up, and in some ways that can't happen in the system. The price has to be continuously going down, it has to be monotonic. And that wasn't exactly the case at some moments in the system here. So why did the price go up here? It certainly wasn't the case that there was some negative probability. Now, of course, if you allow n to move, it could do that, but more likely this was maybe due to the intervention that was happening at that time. So that's part of the answer. The other part of the answer is, is this, oops, wait a second here. I don't know what it's doing. Let's see. Is this underpricing that I alluded to on the right-hand side, right? And so the blue is the price for the UST. And if you imagine somebody was trying to trade this on Binance, he would say, well, if the system collapses, maybe I get nothing for it. But if it recovers, I get $1 for it. How much should I be willing to pay? Well, if the probability of a collapse is 60%, then I should be willing to pay 40% of it. So I should look at the probability of it not collapsing. So the non-suspension probability is what tells me the price. And so you can compare this non-suspension probability that comes out of my calculation to this price, and it's a price floor. Maybe people are willing to pay even more for the UST, but if you're doing sort of buy and hold until this is all resolved, that would be the price floor. And I'm sort of it's nice that that's a floor, but it's a weak test, but that it doesn't seem to be. There's a sense in which you can't test the variables because there's no other way of observing that. If there was, we could do that, or if there was some other theory, you could test that, or we could evaluate that other theory was this theory. But it seems to be maybe in some ways a priori impossible.
So Harald, can I ask one follow-up? I tried to raise my hand, but I don't see my voice. So it may be exactly when Michael mentioned about heterogeneous beliefs, so it related to Jinago plot, that kind of the model. So one implication is, for example, you are pessimistic, you are thinking high lambda, it will recover very soon. I'm the pessimistic guy, I'm thinking low lambda. So one implication will be you will try to take leverage and buy more Luna, and I'm the pessimistic people, I will try to short sell the Luna. So maybe we have implication from other, for example, from seeing the funding rate of the Luna, or the saving volume or borrowing volume can have some implication consistent with this heterogeneous lambda story as well.
Yeah, no, I mean, I have sort of heterogeneous beliefs, actually heterogeneous costs for the terror, right? I mean, why would some people burn the terror when other people don't? So either this was because the terror token was still tied up in some contracts, or it was due to some heterogeneous beliefs, but that's tricky. But then it's tricky. How do you think in general equilibrium about these heterogeneous beliefs?
Right. So it has some implication on leverage. So people, if I'm the pessimistic people, I will short sell. Right.
Right.
So
you would like to short sell. No, that's right.
Yeah. Right. So that implication can be tested.
Yeah, I don't think short selling. I'm not sure whether smart contracts allowed short selling. They might have. It's not something that I checked, but I mean, in principle, right? How do you get trade going, right? I mean, that's sort of, I think that's a general puzzle in many financial markets, right? That that if everybody believes the same thing, then, I mean, you can get a price, you would agree on a price, and the price would be such that neither of us would be willing to buy or sell. At least, maybe we buy or sell because suddenly we have a liquidity need, but not because of, but there was active trading, right? And so the active trading suggests probably that there are, different beliefs, heterogeneous beliefs in the market. I'm totally sympathetic with that. But again, then you get into these, Groucho Marx type phenomena, right? If I buy from you, I should say, maybe I shouldn't have, right? Why was the idiot buying, right? When you wanted to sell, you wanting to sell to me tells me something, and the other way around. So how do you, and now mind you, the theories that you alluded to, take that into account and sort that through, and then pose short sale constraints, always in the hands of the most valued people and so forth. And you can do that. I tried that initially. The theory gets incredibly complicated and rich going that route. And so that's why I impose heterogeneous beliefs here. Homogeneous beliefs here, at least as far as the Luna traders are concerned. It would be interesting. I agree. If somebody can write that down successfully, I mean, that would be fantastic. I encourage people out there doing that. I'm not saying this here's the last word.
Thank you, Harald. And Michael Lee has his hand up. Would you like to ask a question, Michael?
Yes. Thank you for the presentation. It was quite interesting. One aspect that that comes to mind is the potential for some more sophisticated suspension and convertibility to be used to better support the market capitalization of Luna in this instance. And I wonder if, in the context of your framework, whether useful in this way. For example, you could imagine that they could have allowed for a more selective way of burn rate and allow for the market capitalization to not be directly affected in that speed in the way that you're showing in this instance, where it's kind of treated more as like a probability. If you can speak a little bit towards more strategic policy.
Yeah, I mean, I guess algorithmic stablecoins, my guess is people aren't particularly interested in resurrecting them, but it's an interesting question, right? And if somebody wanted to do this, I mean, I think there were a lot of clever choices made, and some choices now, in particular in light of these theories, could be improved upon, right? And I think that's what you are rightly arguing. It's good to think through the incentives of the traders here, right? I mean, what you could do, for example, you might think, well, if you burn, right, you don't want large burning because maybe that has too much of an impact on the price. You might be tempted to limit the amount of burning that goes on. But if everybody understands that a lot of burning is going to come over the next 2 days, then it doesn't really matter whether the burning takes place kind of right away or whether the burning takes place over 2 days. As a rational trader, you have to think about what's the price when all is said and done. And that's the price you would want to pay for Luna at the beginning. That is, once everybody understands that there's going to be continuous burning for the next 2 days and that there's no end, no exit out until then the price should drop, by the corresponding amount right away. The simple model would give you the answer there. So you would have to somehow hope that if you slow down the amount of burning, that you can somehow also end it all, right? So but where would that be coming from? So maybe by slowing it down, I mean, and I don't think we have a good model of that. Maybe you could, by slowing down the burning, maybe you could you calm markets, have sort of the idea of circuit breakers, the ideas of restoring calm to the market, of giving some people the opportunity to be on the other side of the market, buying the terror and and maybe restoring sanity this way. But it's all people believe the burning will continue. The belief will, then, so how do we think about panic? I think it's very, very hard. I guess we're seeing a play out of this now with First Republic, right? Where some banks step forward and says, oh, no, First Republic is fine. They deposited their own money, didn't have financial markets. So it's unclear how to stop, panic reactions and distrust on markets. And I don't think we have a good theory.
We have one last question by Lucas.
Thank you. Hi, Harald. Thank you. Amazing paper. Very simple and technical question. What's wrong with the negative burn rate that your model implies? The negative burn rate would just be interpreted as the Luna Foundation putting in this much negative supply.
Yeah, no, nothing wrong with the negative burn rate. I totally agree. I mean, I have to think whether
well, someone has to unburn, but you have an agent in reality who did do that. That's the one that was intervening.
No, totally right. No, the plot that I showed was about the exit hazard rate, right? I mean, the probability that you think it's going to end, right? About the probability that the system that the nightmare is over and everything goes back to normal. That probability can't be negative because it's a probability, right? Probably can't be negative. But the burn rate, yes, absolutely can be negative, and that would be could have been the case, and again, that's about this intervention that out of a sudden the Terra Luna Foundation would go and use their 3 billion. I don't know whether they tried. They might have. I don't think they did, but they could have used their 3 billion to buy lots of Terra USD and then actually go the other way, right? And maybe buy a lot of Luna, right? I mean, they could have bought a lot of Luna and burn it into Terra. And then we would see negative burn rates. but we see the burn rates, right? We can get data on the burn rates. So we got the quantity, right? So that was sort of, you know, reading the data from CoinMarketCap sort of line by line. But but on that we have data, so we know how much burning took place and whether it was negative or was positive. So we know the outstanding stock of the Terra coins, and that's what I used in order to make the inference. And it is true, when you go back to the beginning of this all, there were a few periods where it was slightly negative. So at the very beginning, there was some creation of Terra going on, but pretty much throughout the sample, it was, you know, nearly always negative. I don't know, probably have a plot in the paper somewhere, but yeah, it can be negative, but it was never sufficiently negative. But you're right, in principle, that's something that the Terra Luna Foundation could have done. They could have tried to, you know, restore confidence by going the other way. And then the question is, would that change beliefs of market participants? And that's the hard one to evaluate. I mean, just, you know, if you just go out there as a politician or as other banks and saying, oh, no, there's no panic, everything is fine, you know, why should people believe you, right? I think that's a generic problem we even have for monetary policy in financial markets.
Thank you very much, Harald. Thank you, Michael, for the discussion. Thank you for all the questions. I think we're right on time. And I look forward to the next seminars, and I'm very thankful to the organizers for organizing this very interesting and lively talk. And I think it is a very nice contribution to our understanding of developments in the crypto industry. Thank you, Harald. Thank you, Michael. Thank you, everybody.
Thank you. Thank you.
Thank you again to Francesca, Harald, and Michael for the interesting discussion on the topical issue, and to all of you for participating today. We hope you will join us again next month. Until then, I hope you have a pleasant day and a nice weekend. Bye-bye.